Hey everyone, welcome back to Corporate Decoder, the place where we unravel the juicy details hiding in plain sight in the world of corporate finance. And today we've got a real treat with National Energy Services Reunited Corp, or NESR's latest filing. Their financial report for the first half of 2025 just dropped, and let's just say there are some interesting shifts happening under the hood. Before we dive in, if you love getting these kinds of unfiltered insights, make sure you're subscribed and join our awesome community over on Discord. The link is in the description below. Alright, let's get down to the nitty-gritty of what NESR is telling us. This report is essentially a check-in on how they're doing financially, especially for parts of their business that are new or showing significant changes. It's like a quarterly update, but they're also filling in some gaps from previous disclosures. Now, the real meat and potatoes start with these financial statements. Let's look at their balance sheet as of June 35 and compare it to the end of last year, December 31st, 2024. First off, cash and cash equivalents. That's the company's readily available money. NESR has $130 million in cash at the end of June 2025, which is up from about $108 million at the end of December 2024. That's a nice little bump, showing they're holding more cash. Then we have accounts receivable net. This is money customers owe them for service and 3 Nala's AB provided. It's up from $137.3 million to about $91 million. That's a pretty big jump. It means they've been doing more business, but it also means they have more money out there that they need to collect. Now, property, plant, and equipment net. This is all their physical stuff like rigs and machinery. After accounting for wear and tear, called depreciation, it's gone down from $438.1 million to $423.9 million. This suggests they might be selling off some assets, or that depreciation is outrunning new investments in this category. Overall, their total assets have grown from $1.77 billion to $1.83 billion. So the company is getting bigger. On the other side of the coin, liabilities and equity, let's look at accounts payable and accrued expenses. This is what NESR owes to its suppliers, and for things like salaries, it's jumped from $305 to $305 million to $352 in $6 million. This increase usually goes hand in hand with higher business activity, meaning they're buying more supplies and services to do their work. Long-term debt has decreased, which is generally a good sign. It's gone down from $254 from $4 million to $222.9 million. Paying down debt is always a positive move for financial health, and their total liabilities are up a bit from $865 to $4 million to $890 and $22.40. Now, for equity, which is what the owners have in the company, common stock and additional paid in capital, which relates to the shares they've issued, is up slightly from $894.3 million to $97.4 million, $4.3 million to $89.44 million is. Retained earnings, which is the profit they've kept in the business over time, has seen a massive jump from $13.9 million. This is a huge increase and suggests the company has become much more profitable recently. Their total equity has grown from $932 million to $93.69 million. Let's shift gears and look at how they've actually performed in terms of making money. This is the income statement for the first half of 2025 compared to the same period in 2024. Revenues for the 6 months ending June 30, 2025 were $631, a slight increase from $621.8 million in the same period last year. This tells us they are bringing in a bit more money from their services. However, the cost of providing those services, cost of services, has gone up more significantly from $525.7 million to $545.7 million. This might be due to rising costs for labor, equipment, or materials. This increased cost of services is eating into their gross profit, which is the money left after directly paying for the services provided. Gross profit has decreased from $96.1 million to $81.3 million. This is a concerning trend, showing their core business operations are becoming less profitable on a gross basis. Selling, general and administrative expenses, which are the costs of running the business, not directly tied to providing services, have gone down nicely from $28 million. That shows good cost control in these overhead areas. Because of the lower gross profit, their operating income, which is profit from the main business operations, has decreased from $50 higher revenues. The business is less profitable at the operating level. Interest expense, which is the cost of their debt, has gone down from $20 million to $16.8 million. This is a positive impact from paying down debt. With lower operating income and lower interest expenses, income before income tax has fallen from $39.4 million to $33.2 million. And their income tax expense also decreased, going from $10.6 million to $7.6 million. This leaves them with a net income of $25.6 million for the first half of 2025, down from $28.9 million last year. So overall, while revenues ticked up slightly, profitability took a hit, mainly stemming from those rising costs of services. The statement of shareholders' equity shows how the equity section of the balance sheet changes over time. Looking at the June 30, 2025 balance, we see the increase in retained earnings we noted earlier, reflecting that stronger profitability from past periods contributing to the equity. We also see here the issuance of restricted share units, which is a way they compensate employees, and transaction costs related to a warrant exchange on the equity. Now, let's talk about cash flow, which is arguably the most important thing for any business's survival. Cash provided by operating activities, meaning the cash generated from the normal day-to-day running of the business, was $119 million for the first half of 2025. This is up from $112.3 million for the same period last year. That's a good sign, showing the core operations are generating more cash. However, their investing activities, which include buying new equipment or property, used more cash. Capital expenditures were $59.9 million for the first half of 2025, up from $52.7 million last year. They are investing more in their business, which can be good for future growth, but it uses up cash now. In financing activities, proceeds from short-term borrowings were $53.5 million, while repayments were $47 million their short-term debt. Overall, the net increase in cash was $23.8 million the first half of 2025, bringing their total cash balance higher. The notes to the financial statements are crucial for understanding the numbers. They explain the accounting rules used and provide more detail. One interesting detail is in Note 2 about Production Management Assets, or IPM. This is where they invest in customer projects tied to future production. They're capitalizing these investments and amortizing them over time. They also mention new accounting standards coming into play, which is routine but important for long-term compliance. Note 3 breaks down their accounts receivable further, showing the total and the allowance for doubtful accounts. They have $13.9 million set aside for potential bad debts, which seems like a reasonable provision given the receivables size. Note 4 details their service inventories, mostly spare parts and chemicals. These amounts haven't changed dramatically, suggesting stable operational needs for these materials. Note 5 gives us the breakdown of their property, plant and equipment. We see buildings, drilling rigs and office equipment. The depreciation expense here is significant, as expected for an oilfield services company. Note 6 goes deep into their debt. They have a $290.3 million secured term loan and a revolving credit facility. The interest rates are tied to SOFR or SAPA, which have gone up, explaining why their net interest expense was higher in the past, though it's down now due to debt reduction. Looking ahead, they have scheduled principal payments for their long-term debt, a significant chunk of which is due in 2026 and 2027. This is important to watch for future cash flow needs. Note 7 talks about their income taxes. Being based in the British Virgin Islands, they have a 0% tax rate there, but their subsidiaries in other regions are subject to various tax rates. The effective tax rate has actually decreased, which they attribute to fewer provisions for uncertain tax positions. Note 8 covers things like capital expenditure commitments, which they have a substantial amount of, and off-balance sheet arrangements like surety bonds and guarantees. These are important to understand potential future obligations. Note 9 dives into warrants. They had an exchange offer where warrant holders could trade them for shares. This has led to a significant number of warrants being exchanged, which will impact future share counts and earnings per share calculations. Note 10 on earnings per share is where the warrant exchange really starts to show its impact. You can see the changes in weighted average shares outstanding due to these exchanges. Note 11 details their reportable segments, production services and drilling and evaluation services. Revenue in production services declined slightly, while drilling and evaluation services saw a nice increase. The lower revenue in production services is explained by reduced hydraulic fracturing stages in Saudi Arabia due to contract transitions. That's a direct impact from changing customer contracts. The boost in drilling and evaluation services is from more well testing and the use of their Roya directional drilling technology. This shows their investment in new technologies is paying off. Geographically, their operations are heavily concentrated in the MENA region, with 99% of revenue coming from there for both periods. This geographic focus means they are very sensitive to the economic and political conditions in that specific area. Then we get to the risk factors and operational reviews. They talk about the cyclical nature of their industry, the importance of commodity prices, and the specific risks tied to their heavy concentration in the Middle Eastern markets like geopolitical instability. When comparing 2025 to 2024, revenues were up slightly. However, the cost of services increased more, leading to lower gross profit margins. While SG&A costs were managed well, the higher cost of services directly impacted operating income and net income. So what's the big picture here for NESR? On the positive side, they've managed to increase their cash reserves and reduce their long-term debt, which are definite signs of improved financial discipline. They are also seeing growth in their drilling and evaluation services segment, boosted by new technology. However, the concerning trend is the rising cost of services relative to revenue, which is squeezing their gross profit margins. This means that for every dollar of revenue, it's costing them more to deliver the service. While they've controlled overheads, this core profitability issue needs close watching. They are investing more in capital expenditures, which is good for future growth, but it does use up cash in the short term. The heavy reliance on the MENA region also carries significant geopolitical and economic risks that they themselves highlight. In short, NESR is growing and managing debt well, but they need to get a better handle on their cost of services to translate that revenue growth into stronger profits. It's a balancing act between expanding operations and controlling costs in a volatile industry. Alright, that wraps up our deep dive into NESR's latest financial report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If you found this analysis valuable, hitting that like button really helps us out, and make sure you're subscribed for more deconstructions of corporate filings, and don't forget to join our Discord community for more in-depth discussions. The link is in the description. Thanks for watching, and we'll see you in the next one.